Have a look at the list of the wealthiest people in New York City. You can find many hedge fund managers are worth many millions and sometimes billions like George Soros of Soros, James Simmons of Renaissance Technologies, etc. Are you wondering how do hedge funds make so much money? In this video, we're going to discuss why do hedge fund managers make so much. The video is going to be amazing, so make sure you stick till the end. The first high-paying jobs that come to mind are celebrities and CEOs, but the highest-paying job with a college degree is becoming a hedge fund manager. So why are hedge fund managers so rich? While pondering the question, you realize that the pay gap is so huge that it has become a much sought-out job for those in the financial sector. The average workday for a hedge fund manager begins early and usually runs late. Hedge fund managing is rarely, if ever, a 40-hour-a-week job. However, being on the ball and diligent can lead to a handsome salary and a rewarding, high-intensity career. A hedge fund typically pays its investment manager a management fee and a performance fee. Hedge funds have existed for many decades and have become increasingly popular. They have now grown to be a substantial fraction of the asset management industry, with assets totaling around $3.2 trillion as of 2018. Some hedge fund managers had several billion dollars of AUM, assets under management. For some, what you wear to an interview is an indicator of how well you'll mesh. If you show up in a suit and tie, you're likely out. You won't fit. In the world of hedge funds, the worse you dress, the more successful you are. Drew Froelich, founder of Strategic Growth, a New York headhunter that specializes in front office asset management placements, said, "A typical day in the life of a hedge fund manager usually involves constant market monitoring and investment evaluation along with research and sales work. The hedge fund manager is the person ultimately responsible for conducting the hedge fund's everyday affairs, such as raising investment capital and rebalancing investments to maintain a given risk-to-reward ratio." Since a hedge fund manager is responsible for handling a portfolio of investments, their position is somewhat similar to that of a mutual fund or ETF, exchange-traded fund manager. Their responsibility involves helping investors with managing their investment objectives, liquidity needs, and fee structures. They typically work long hours for investment banking firms, asset managers, private equity firms, and hedge funds. They require close monitoring, decision-making, and a greater amount of day-to-day hands-on management. Their task is mostly spent on investment analysis, building models, and meeting clients. To be successful, a hedge fund manager must consider how to have a competitive advantage, a clearly defined investment strategy, adequate capitalization, a marketing and sales plan, and a risk management strategy. One of the biggest misconceptions people have is if you work at a hedge fund, then you don't really have to do a lot and you make a lot of money and you have a great life forever. But that's not reality, says Afroz Kadir, the CEO of Kettle Hill Capital Management and a member of the Mid-Atlantic Hedge Fund Association. People think you're essentially a master of the universe, but in reality, you put in a lot of hard work, a lot of long hours. Hedge fund managers become rich by making money on the profits of their assets. They charge a 2% performance fee and cut the generated gains, which amounts to about 20%. The performance fee is calculated from the profit generated by the funds. This fee is more of an incentive that encourages the managers to perform well and generate excellent returns. The management fee is a percentage of the assets that the firm manages. These fees are paid regularly, either monthly or quarterly. They charge about 2% as a standard, but can get as low as 1% and as high as 4% based on their assets. First, it's extremely difficult to detect from a fund's track record whether a manager is actually able to deliver excess returns, is merely lucky, or is an outright con artist. Second, we show that it is essentially impossible to redesign the incentive structure so that it keeps the con artists out of the market. Any contract that rewards skilled managers will also confer substantial expected rewards on the unskilled and unscrupulous managers as well. Foster and Young Wright. Top hedge funds earned $63.5 billion in 2020, the highest in a decade. Hedge funds are always among the ultimate destinations on which top financial graduates dream to land their job. Its lucrative income, some of which reach 7 digits a year, is the key driver for elite individuals to aspire to fund manager roles. Your net worth would possibly be well into 11 figures just like ones of these big names: Jim Simmons, Ray Dalio, Steve Cohen, etc. Jim Simmons. James Harris Simmons is an American mathematician, billionaire hedge fund manager, and philanthropist. In 1982, he founded Renaissance Technologies, the quantitative trading firm dubbed RenTech for short, manages about $80 billion and reportedly had one of its worst months this decade in February, with assets falling 7%. Its public funds have struggled to recover, but RenTech's black box medallion strategy, which is open only to company employees and select relatives, boasts annualized returns of 66% over a 30-year period. Simmons, a former codebreaker for the US during the Vietnam War who's retired but remains invested in RenTech funds, is up an estimated $1.5 billion since last year. Efficient market theory is correct in that there are no gross inefficiencies, but we look at anomalies that may be small in size and brief in time. We make our forecast, then shortly thereafter we reevaluate the situation and revise our forecast and our portfolio. We do this all day long. We're always in and out and in, so we're dependent on activity to make money. Ray Dalio. Raymond Thomas Dalio is an American billionaire investor and hedge fund manager who has served as co-chief investment officer of the world's largest hedge fund, Bridgewater Associates. By April of this year, assets at his Bridgewater Associates had fallen to $138 billion, a $30 billion drop from the end of 2019. The world's largest hedge fund firm laid off dozens of employees in July, just days before a former co-CEO filed a suit alleging that Bridgewater was withholding up to $100 million in deferred compensation because she publicly disclosed a gender discrimination dispute with the firm following her April departure. Bridgewater says it's working to resolve the matter. I believe cash is and will continue to be trash. That is, have returns that are significantly negative relative to inflation. So it pays to A. Borrow cash rather than to hold it as an asset, and B. Buy higher returning non-debt investment assets, he wrote. Steve Cohen. Stephen A. Cohen is an American hedge fund manager and majority owner of the New York Mets of Major League Baseball. Cohen oversees Point72 Asset Management, a hedge fund firm that reopened to outside investors in 2018. Point72 closed the first half of 2020 on a high note, hitting $17 billion in assets. The firm stopped accepting new money in July after raising a $10 billion fund, but Cohen's been cautious. In the meantime, Cohen's bidding high for the New York Mets. He's already a limited partner in the team, but is reportedly looking to buy the whole club for upwards of $2 billion. It's hard to find ideas that aren't picked over and harder to get real returns and differentiate yourself. We're entering a new environment. The days of big returns are gone, Steve Cohen said. Being a hedge fund manager is not fun. It's tiring work with long hours, but the high pay makes it worthwhile. Only a handful of the hedge funds perform great and have done exceptionally well for their clients. Whether they can continue to do so is the question. However, in most cases, hedge funds charge more for below average performance. Hedge funds lose money, but mostly the clients cover all the losses. The managers get paid on a 2 and 20 structure where they earn a 2% management fee irrespective of profit or loss and a 20% performance fee if the funds perform well. Hedge funds don't allow anyone and everyone to invest. You should be worth at least $1 million or draw a salary of $200,000 per year for 2 consecutive years to be able to invest. The stakes are high, but they give a high return. What's your opinion about hedge fund managers and their highest paying job? Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel, hit the bell icon for more updates and notifications. Stay safe, and we'll be back soon with another video.